Hey guys, welcome back to the S&P 500 valuation analysis. We are here in mid-November. It is almost Valentine's Day, and I haven't done one of these videos in several weeks, I think probably since the middle of January. So let's get started. So as a reminder, this information and presentation is my opinion only, certainly not financial advice. Should you have any questions for yourself, please consult a financial professional that can help you with your specific situation. So a bit of housekeeping here, just a reminder of, why we're doing this work, and really what we're trying to do is, at the end of the day, determine the attractiveness of investing in the S&P 500. We're going to look at high-level ratios and relationships. We're going to look at the S&P 500 from a top-down perspective. So we're going to try to understand how those ratios look relative to history. And really the analysis that we do is rooted in, I hope, objective measurements, right? We're trying to avoid emotions. We're trying to avoid a lot of what people get caught up in the market on a day-to-day basis. We're trying to put that to the side and really look objectively at how the market is performing. And as a final note, everything that I do here in this video is done using publicly available information, and you can certainly do this on your own if you are so inclined. So let's get started. Let's look at the S&P 500 today. Before I do that, let's look on a longer term basis. You can see, of course, over long periods of time, the S&P 500 is generally a very safe investment, even though there is a lot of volatility in any given year or any given month. So if you're looking at the long-term investment strategy, the S&P 500, as Warren Buffett likes to say, betting on America, is a pretty good wager. Now, the smaller chart that you will see here is looking at the past 6 months. This is what I like to look at just on a proxy for the last 200 days, if you will. And as I mentioned back in January, the last 6 months I would say has seen quite a bit of chop, right? So, the overall return has certainly been good, but if you look back through, I would say mid-November, this has been a pretty range-bound market, either side of roughly 6,000. And even as we've kicked off the year here, there certainly has been more volatility, I would say, just thinking back over the past 3 to 4 months than we saw certainly over the past several years. So just something to keep in mind as we look at some of these ratios. Before we get into some of the other data here, I just want to focus on really some of the basic price to earnings ratios that a lot of people like to look at, and I look at these with limited value. Certainly the nominal PE ratios, the price to operating earnings, or the price to reported earnings. Those are something that you can look at and look at history and get a rough understanding of where the market is. I certainly prefer the CAPE or the Shiller ratio, the cyclically adjusted price to earnings ratio, more than the orange or the blue lines. At least the CAPE takes into account inflation, and I feel like it smooths out a lot of the volatility. But when you look at these, at any of these ratios, you can see where we are today. Certainly not the lowest we've been. I would call it an elevated environment, so something to pay attention to. The CAPE in particular, somewhere right today in the mid 30s, not as high as it has been back in the late 90s, early 2000s, but it is in a position that warrants some attention, and certainly something to keep an eye on. Now, I'm going to spend a lot of time in this video, and I do in all my videos, not necessarily talking about the S&P 500. I actually spend more time talking about the bond market, because I think fundamentally, if you want to understand the value of the S&P 500, you really need to understand the bond market and why that is important. And I'll get into that in a second. But, if we look at this chart from the Wall Street Journal, looking at the yield curve today versus where it was a year ago, the curve today certainly, looks what I would say a little more normal. Certainly the overnight rate, where we were a year ago, approaching 5.5%. There's been, quite an effort by the Federal Reserve to lower the rate. It's gotten down, I think, around 100 basis points, and today is sitting somewhere between 4.25% and 4.5%. But if you look out towards the longer end of the curve, specifically at the 10-year or the 30-year, whichever you like to look at, these rates remain elevated. And I think this is the primary concern when you look at the S&P 500, is that, even as those short-term rates come down, there's a lot of question around where long-term rates are going to go. Why does that matter? I think this is important. I've shown this slide a couple of times before. Why do those long-term interest rates matter when we talk about the S&P 500? And fundamentally, at the end of the day, depending on where those interest rates fall, it allows for a different fair value on the S&P 500. And so what this chart does is it shows you a range of interest rates, a range of long-term interest rates between 0 and 15%. And on the vertical axis, it shows you the corresponding fair value, the fair value price to earnings ratio of the S&P 500. And I've broken this into three sections, the green, the yellow, and the red, to show you the effect of what I would call low interest rates, or interest rates less than 3%. In yellow, the effect of moderate interest rates, or what I'm calling interest rates between 4 and 6%. Or the area in red, what I'm calling high interest rates, or those above 7%. And you can see where we are today with the dotted lines. We're right, again, between 4.5% and 5%. And where that intersection of that line comes in, it shows you that fair value, the fair value or the corresponding fair value price to earnings ratio of the S&P 500 is just above 20, right? And this matters. If you think back to where we were coming into the COVID situation and how interest rates drop aggressively, we saw long-term rates, get between 1.5% and 2%, right? And when you have those rates that get that low, again, this curve is not linear, right? As rates get below 3%, that fair value price to earnings ratio goes up dramatically, right? And so we saw a corresponding PE ratio of what I would call fair value back in 2021 that was up above 60, approaching 80, right? And that's why we had such a tailwind for stocks to perform so well, and they have performed so well. But over the last couple of years, we've seen the long bond go up considerably. Again, today we're sort of, approaching 5%. We've bumped up against it. We've fallen back a little bit. But this is the reason that matters, right? You're going from a fair value price to earnings ratio of around 80, now down closer to 20. So again, as we take that fair value from the last slide and we show that, look, fundamentally, if you look at the long bond, that corresponding fair value on the S&P should be around 20. And this graph helps to show that, right? So if you look at the PE of the 30-year Treasury, which is in orange here, this is what we just talked about, right? Today, that PE, or the inverse of the earnings yield on the long bond, is just above 20. And you can see on this graph how that has come down dramatically over the last 3 to 4 years from where it was around 70, right, or even above 70. The S&P 500, on the other hand, where we have spent much of the last decade undervalued, in other words, that blue line has been below the orange, we've hit an inflection point, over the past 12 to 18 months, where the S&P 500 today appears to be overvalued, relative to the long bond. And I think this is an important takeaway from this video, is that, for a long time here, coming out of the great financial crisis, the S&P 500 had a great tailwind, had a great opportunity to do very, very well, and it did. And today that environment has shifted a little bit. So I think this graph, talking about the equity risk premium, is probably one of the most important graphs in this slide deck. And really, if you're not familiar, the equity risk premium is actually a very simple concept. It's the difference between the earnings yield on the S&P 500 and the long bond, really just taking the difference between those two. And so on this graph, you can see the horizontal line at 0, showing the area above, or the area that I've indicated in green, being more attractive for investing in stocks. In other words, the equity risk premium is positive, versus when the equity risk premium is negative, or where I've indicated in red on this graph, an area that is less attractive of investing in stocks. And we talked about on the last slide how over the past really 10 to 12 years coming out of the great financial crisis, we were really in an attractive environment for investing in stocks. And the equity risk premium showcases that, right? If you look around from 2010, even up to into COVID, right, we were in a positive equity risk premium. This was an environment that was relatively attractive for investing in stocks. But you can see, especially over the last couple of years, as yields on the long bond have increased, even though stocks have done very well, I would say the underlying environment for investing has become less compelling. And look, if you look at this graph, a couple things I would note. Clearly, we're not in an environment that was as attractive as it's been over the last decade plus. But we're also not in what I would say an environment that's as bad as it's ever been, right? I would say this is another graph that warrants attention. It warrants a little bit of caution. I want to just finish with a couple of high-level ratios. The first one is the S&P 500 to dividend ratio. If you like to use dividends as a proxy for value, this is another graph that shows we are on the higher end of valuation. Certainly not where we were back in the late 90s or early 2000s, but we have been creeping up, and we are in an area that is certainly higher than I would say the long-term average is. The next graph is showing the S&P 500 to GDP. This is also known as the Buffett indicator. Warren Buffett has said historically that at any given time, this can be one of the better ways to value the market. He also says there are limitations with this. So again, take this analysis with a pinch of salt. But however much weight you put into this particular ratio, you can see that, again, looking back historically over the past 60 plus years, we are in uncharted territory. So again, a ratio that typically I would say on average likes to fall somewhere around 0.1 to 0.12 is now well above 0.2, well above the historical average. And this is one that I think really, again, depending on how much weight you put into this particular ratio, one that would get your attention and certainly gets my attention in terms of where we are with the S&P 500. The final one we'll look at is just the S&P 500 to book value. Again, I don't have quite as much history here going back to the late 90s, but again, if you think of the late 90s as a period of exuberance or perhaps overvaluation, we appear to be in that same area in terms of valuation. And again, this is something that gets my attention and would suggest that the market is less than a compelling area to invest right now. So if we look at this chart and we see where the S&P 500 is today versus where fair value is. Again, fair value is looking at a combination of earnings estimates. It's looking at the long bond yields. You can see today we have the S&P 500 that is, sitting around 6,000. It's bounced around a little bit. Has gone up above, closer to 6,100. It's gone down. I think back in late December, early January, I think it bounced down, 5,800 and some change. So again, somewhere around 6,000, but fair value somewhere in the mid 4,000s, right? You can argue, is it 45, 44, whatever that number is. But fundamentally, again, we talked at the beginning of this video about the S&P hitting an inflection point, right? Where the S&P has been, for such a long time now undervalued relative to the long bond. And this graph, I think, kind of pulls that all together to say, look, that inflection point, what does that mean in terms of actual numbers? And so, again, something to keep an eye on. Again, doesn't mean the market's going to fall out tomorrow. It doesn't mean it's going to fall out at all, but certainly is worth keeping an eye on as we go forward in 2025. So let's wrap up this slide, look at the final numbers. And just as a reminder, the way I like to do this, all of those metrics that we talked about in this video, I like to assign a color code to it. So, green, amber, or red. Green meaning the investing environment is compelling. Amber telling me that the risk reward is somewhat neutral. And red telling me that risk reward is unbalanced or there's some downside risks, right? And today, of those 7 metrics that we look at, I've got 4 showing red and I've got 3 showing amber. So again, this is not an environment that I would say is compelling. It's not an environment that I'm particularly inclined to just dump a bunch of money in. Again, if you want to assign specific numbers to it, I show the market as roughly 30 to 35% overvalued, somewhere in that range. Fair value somewhere in the mid 4,000s. Our current value again, 6,000 plus or minus a little bit. So again, when you look at things like the equity risk premium, the CAPE, some of those, the Buffett indicator, the S&P to GDP, all those ratios, have different levels of importance. They all are important in their own way. And they all are, at different degrees of, where they are in terms of valuation. So, but again, all of the things that I look at, none of the ones are flashing green. Everything is something to keep an eye on. And I would say the S&P, again, is unbalanced, right? I think there is some downside risk to this market depending on, what long bonds do, depending on how earnings estimates come in, over the next couple of quarters. We'll keep an eye on the market. Again, if there's one thing I think we're moving into, it's probably an area of more volatility, obviously the political environment has changed and the market needs to adjust to that, what that's going to be and try to understand how that's going to impact earnings and different companies that have different risk exposures. So anyways, I hope you found this video helpful. This series is something that I try to do at least once a month to give you guys just a pulse check on how the market is doing. But if you like this video and you found it useful, please give me a thumbs up or even subscribe. It helps me grow this channel and helps show me if there's interest in this and it's worth taking the time to do this analysis. But I really appreciate you watching. Good luck if you're out there investing, and we'll see you next month.